Hello everyone, it's Dylan, and I'm here with Keller Williams at the Metropolitan office, and I'm here with my good friend
Geoff Dolive with America's Choice Home Loans.
And today we're really going to be talking about mortgages. We get a lot of questions is like, what mortgage is the right for me? What's the right mortgage for me? Or what is the right loan product? Or really what's going to help me get into a house? So there's a lot of technicals, and that's really why I brought Geoff in as an expert in mortgages to help explain some of these things, because he deals with it on a daily basis, where I more so deal with on the houses of anticipating markets, and additionally, what is the house really worth and what's the right house for you. So Geoff, what are the most popular types of mortgages that you kind of see on a daily basis?
Well, in an overview, not everything all inclusive.
Of course.
But generally there's going to be conventional. And then there are the government loans.
Okay.
So FHA, VA, USDA.
Okay, so very good. And then in terms of when it comes to a buyer, is it really specific on the needs that need to be met by a loan, or how does it go in terms of placing someone with a particular loan?
Sure. Well, we're going to look at the individual and understand what their goals are, and base it on that.
Okay.
So everybody has a different need.
Yep.
Every loan is different.
Okay. Yeah.
So some people want to avoid mortgage insurance.
Okay.
Or at least be in a position to make it go away.
Yep.
Some people have a higher debt to income ratio.
Alrighty.
That we need to deal with. If someone is a veteran,
yep,
they want to take advantage of a VA loan, for
okay.
example.
So when it comes to mortgage insurance, what does that mean for a standard buyer?
So mortgage insurance was developed to prevent somebody from being required to put 20% down.
Okay.
That is the point.
Okay.
And with mortgage insurance, there's a couple of different ways it can work.
Okay.
Sometimes there is both an upfront premium and then a monthly.
Terrific. Okay.
There's a single premium sometimes,
yeah,
to do it. But most often it's just an expense that's added monthly to the mortgage payment,
okay,
to guarantee the loan.
So it's really about someone being able to get into a home with lower down payment. Is that correct?
Without the 20% down. Correct.
Okay. So in terms of when it comes to each type of loan, could you tell me what is the benefits and disadvantages to each type of loan?
Sure.
So what do we want to start with?
Let's start with FHA.
Sounds terrific.
So an FHA loan, one of the big benefits is it only requires 3.5% down.
Okay.
It also allows for a higher, again, debt to income ratio.
Alrighty.
So if someone has, a lot of credit card debt or multiple vehicles,
yep,
a lot of student loans, etc., but they still want to qualify for more home,
yep,
that might be the right product for them.
Okay.
If their debt to income is higher.
So we see this more so for first-time home buyers, right?
Very often, yes.
Okay. And then how about VA loans?
So a VA loan is a great loan.
Okay.
If somebody is a veteran or a surviving spouse,
yep,
this is an excellent opportunity for them.
Terrific.
They do 100% financing. They have what's called a funding fee rather than the mortgage insurance, and that's on a sliding scale depending on if it's your first use or not. There's a couple of factors.
Okay.
But I think it's a great loan for anybody who qualifies.
Okay. And USDA?
So USDA, we're here in the Houston area.
Yep.
USDA, if you're looking in the heart of Houston, it's not going to qualify. It's really for rural areas. So you got to get away from town a little bit.
Yeah.
And it's honestly, it's designed for low to moderate income buyers.
So we'll see this more so outside Beltway, maybe closer to Rosenberg, outside Pearland, maybe Montgomery or Fort Bend counties.
Exactly.
Very popular, and then even whether you get closer to Dayton and Liberty and stuff like that.
Absolutely. You got to get away from Houston.
Okay. Mm-hmm. So more of that type of loan. Okay. And then those are, from my understanding and my research and what I've done now with my clients, really each property can really qualify. You just go to their website and say, hey, does this property meet USDA? And then it'll say yes or no.
Correct. There's a great website, USDA eligibility map.
Okay.
And that will really lay it out and make it simple so you know if that area qualifies or not.
Yeah. So now let's say conventional loans. This is a loan more so for people that are, well, just explain it for me.
So a conventional loan, again, the biggest benefit overall is the long term, the overall cost is going to be lower.
Okay.
Obviously, if you have 20% to put down, no mortgage insurance at all.
Yep.
If you don't have 20% to put down, the mortgage insurance can go away over time.
Alrighty.
Which again just brings the overall cost down.
Okay.
Not only is it good for a primary residence, also good for second homes or investment properties as well.
And when it comes to each of these loan products or types of loans, there's some disadvantages to them. Can we just run through the quick disadvantage to each one of them and just list them through?
Sure. So again, I'll start back with the FHA, again, that mortgage insurance.
Okay.
It has both an upfront and a monthly premium that has to be paid. If you don't put at least 10% down, it's for the life of the loan.
Okay.
So you're kind of stuck with it forever.
Yep.
If you put 10% down, it will go away, but it's still for 11 years. That's probably the bigger disadvantage to an FHA. VA, I really don't think there's a lot of disadvantages to it. Just if you're not a veteran or a surviving spouse, you don't qualify.
Well,
and can't use it.
It's really a contribution to them and the support of their service. So I think that's a wonderful loan.
It is a benefit, absolutely.
And a great attribute for their service.
And then USDA. Again, it's a good product. The disadvantages are if you're in a major metropolitan area, you can't use it. If your income is too high, you won't qualify for it. So, like I say, it really is intended for rural housing, low to moderate income.
And more specifically, the government loans, it's really about what is the best type of mortgage for you, really. So, and depending on how your financial circumstances are, or really what your financial goals are, I think those are super important when it comes to buying a property or a home or an investment property. What is your plan? What is your intentions? Do you plan on staying there for 5 years, 10 years? Do you want to stay the life of the house? Is this your, or really, as we know in Houston, we see sometimes people stay in between the houses for 3 to 5 years. But can you, let's get to conventional first, and then I'll get into the point I was going to bring up.
Okay.
So, in terms of conventional, is there really any disadvantages, or what would you say is a disadvantage?
You have to have a higher credit score to qualify.
Okay.
So if you're struggling with your credit score, you may not qualify for it.
Already.
Again, conventional is a lot of people would consider sort of the gold standard of what to go to and what to use. So no, I really don't think there's a lot of disadvantages other than, again, you have to have a higher credit score and your debt to income ratio needs to be a little lower.
One thing I think I forgot to ask, what about is there certain loan amounts specific to each type of loan?
There are. So they call them loan limits, and it's going to vary according to the type of loan in the county. What we haven't discussed is what they call a jumbo loan. So jumbos are a little bit different, and that's typically not going to be somebody's first home. It's probably they're putting some money into the deal. And it's going to be obviously a nicer home. You're probably not looking at a jumbo unless it's $500,000 home or better. And again, they're very much along the lines of a conventional.
Okay, terrific. And one thing I think I was going to say before in regards to each type of loan, when it comes to purchasing a house or investment property, if you will, what would you recommend as their first step in that process? Would you say getting approved first, or start looking at houses right away?
Well, I definitely think that they should talk to a mortgage person. They need to explain what their goals are, what their situation is, and let that person, hopefully me,
we trust it will be.
Talk about what the situation is. Understand their goals, understand what payment they're happy with, and really get an idea of what their purchasing power is, and do they want to go to the limit of it, or are they trying to keep their payment in a certain range? But no, you definitely want to get approved. There's no sense in going out and looking at a home that you can't qualify for.
Yeah.
And I'm sure you don't want to be spending your time driving someone
That's
around
exactly
to show
right.
them
I
the
was just
wrong
gonna
home.
mention that. Really, when it comes to buying your home or your property that you're looking forward to, it's really the first step is speaking with the real estate agent, and then also speaking with a mortgage lender or a mortgage person, so you can have a higher understanding of your finances, so it creates more of a seamless process from beginning to end. Because a lot of times consumers or buyers, when looking for a home and they haven't been approved, they're like, okay, well, I want this house, and based on this mortgage calculator that I saw online, this is what I can afford. And that really doesn't necessarily consider all factors when it comes into it. And it can create some added stress if you're out looking at a home and it comes to it and you want to make an offer on that home, and then you're not able to have the funds to purchase it. So that could be really unfortunate, and I've seen it before with some buyers where that happens. So it's very important and evident that we start with the process of understanding the situation,
Mm-hmm.
and therefore translating that to looking at houses to be able to find that dream home or that dream property that you're really looking for.
Well, and along those lines, unfortunately, there are a lot of websites who will just show the principal and interest portion of the payment, and it does not account for taxes and insurance.
Okay.
And people will be surprised when they understand that payment is much higher.
Yeah.
Again, taxes and insurance are going to be part of it.
Yeah.
Even if the home is paid off, you certainly are still going to be liable for taxes.
Yeah.
And most people still want to have their home insured.
Okay.
So I do find that to be an issue from time to time, that
Yeah.
a person will look at a website and they'll see the principal and interest payment and think that that's all it's going to be.
What about when it comes to rate? A lot of times we're in historic lows for rates at this point, and while we've seen them slightly increase and now decline slightly, what is it when it comes to rate? What makes up a rate, or what gives someone a specific rate?
Well, there's a lot of factors in that.
Of course.
The bigger things, a lot of times it's going to be determined by the overall risk.
Yep.
and an individual's credit score and their debt to income.
Okay.
Again, now again, there's bigger pictures.
Of course.
Bigger things in play.
Location, tax record, fees associated with the property, whether it be HOAs, things of that matter.
Correct. And rates are going to go up and they're going to go down.
Yep.
But at the end of the day, on any given day, if a person has a better credit score or they're putting a little more down, they're probably going to see a more favorable rate.
Okay, so it's about the the financial health of the individual.
The overall risk is really what it boils down to.
Okay, very good. Geoff, do you feel like there's anything that we missed today in terms of when it comes to loans or for first-time home buyers? And additionally, is there any good tips that you'd like to offer?
Well, again, a lot of times, especially with first-time buyers,
Yeah.
there seems to be a big misconception out there that someone needs to have 20% down.
Yeah.
And that is not the case.
Uh-huh.
There are a lot of different options out there.
Yeah.
There are down payment assistance programs. There are seller concessions. There's ways to make the deal work.
Yeah.
So the first step, again, would be get in touch with a mortgage person.
Okay.
Talk to them about what your situation is and what your goals are.
All right.
And what I always tell somebody is, if I can't get you approved now, I can at least give you a roadmap, and you'll know where to go.
Exactly.
That way you've got a specific to-do list
Yeah.
to be able to get approved, or you may be approved now.
Exactly. And for those that are approved now, and they're actually renting, what is the trade-off versus renting and owning?
Certainly. Well, most right now, like you talked about, the rates are historically low.
Yep.
And so we're not dealing with much in the adjustable rate mortgage right now. Most everybody's doing a fixed rate.
Yep.
So the great thing is, once you lock that in, no matter what the length, whether it's a 15-year, a 30-year, or somewhere in between, that rate is that rate, and you're going to be locked in. The only variables are going to be if your homeowner's insurance perhaps goes up, or if the tax rate changes. But for the most part, that's going to be steady.
Okay.
Rent goes up, seems like just about every time that lease ends.
Yep.
Somebody might get lucky and get to renew it one time at the same rate, but you can pretty well guarantee that it's going up. It always does. Plus, you're not building any equity. There's when you're purchasing the home, if you move 5 years down the road, you've got something to show for that payment you made every month.
Okay. So when it comes to when you buy your house, when do we see that people start building equity into their houses? Or how many years in would you say?
Again, there's a lot of different types of loans, and there's a lot of ways that people do it. The farther you get through the loan, the more of that same payment is going to go towards principal.
Okay.
So, frankly, the very first mortgage payment you make is going to be the most interest you'll ever pay. And then it's a sliding scale all the way to the end of the loan, where there's almost no interest. It's almost all principal. But a lot of people are able to take advantage of, they get a tax refund, they get a bonus. Maybe they want a 30-year mortgage so that they can have a lower minimum monthly payment. But they want to apply more towards the principal on a regular basis. And that's also a good way to pay it down.
See more of an equity position.
Correct.
Well, Geoff, I want to thank you today, and I'm sure everyone out there is very appreciative of you sharing all these great mortgage tips. And we look forward to working with everyone out there that's interested in these type of services, whether it be real estate mortgages. And we thank you guys.